Hey guys, welcome back to the channel McNallie Money, the new home of power mining analysis. In today's episode, Anthony Power and I are going to be joined by the CEO of CORZ Scientific, Adam Sullivan, for his first appearance on the channel. We've got a lot to go through in today's presentation, but before we do, please take a second, hit the like button, you guys. It's a huge help to myself, the channel. Anthony loves it, and it's 100% free to do. If you're not already subscribed, McNallie Money, feel free to join, and let us know in the comment section below if you're currently holding shares of CORZ Scientific, what your thoughts are on this organization, and their outlook for 2024. Now, with that being said, let's get into today's interview. Okay guys, so that's right. Today's video, a very special guest, his first time on the program, Adam Sullivan, the CEO of CORZ Scientific. Now this is one Anthony and I have been receiving a ton of questions, attention, interest about. So Adam, very happy to have you on the program today and welcome to the channel.
I appreciate it. I'm looking forward to today. Should be fun. Been reading and listening to you guys for a while.
Hey, we like to hear it. Appreciate the support. So we've got a long list of questions. A good portion of these were actually pulled from Patreon and subscribers. So another benefit of this platform or conduit, Adam, is we can get questions right from the retail audience. So we'll go through these in a second. But first and foremost, because it's your first time here, can you give us a quick background on yourself and what CORZ Scientific is really about?
Sure. So I started my career in crypto. Well, before that, I was in the financial industry, but I started a crypto investment banking team in 2017. One of the things that we really pride ourselves on was, even through what I'll call kind of bear cycles, we stayed with it. We were very active even during those time periods. We started working really closely with mining companies since I was mining before that myself in about 2018. And we ended up working on a number of the deals in the space, including many, I would call them industry-changing deals. Worked on a lot of capital raises, working on a lot of go publics. One of the companies I worked closely with was CORZ Scientific, and I had the chance to join CORZ Scientific in April of 2023. So CORZ Scientific, most of the listeners probably know who we are, but we've been the largest Bitcoin mining company for the past 4 years. We're still the largest mining company as of today in 2024 in terms of Bitcoins mined. We have 7 facilities across 5 states. We've mined 34,000 Bitcoin in the past 3 years, far outstripping any of our competitors. And we have an amazing organic growth plan going forward. We are operating 724 megawatts today, 372 megawatts partially developed, which is larger than many of our competitors in terms of facility space. And so going forward, we have a great opportunity ahead of us.
Excellent. That's really good. I mean, we know 2023 was a challenging year for CORZ Scientific in terms of the Chapter 11, but a great year in terms of Bitcoin production. You've already articulated that you've produced probably about 10,000 more coins, or maybe more than the likes of Marathon have in the last 3 years. Are you able to sort of articulate some of those challenges you faced during that year? And also, from emergence, some of the highlights as well, because it wasn't all doom and gloom for the company. Can you articulate some of those?
Sure. So I joined in the middle of the bankruptcy process. I joined in April of 2023, so we were about 5 months into the process at that point. We were in the middle of negotiating with our creditors. We had a number of different creditors. We had a number of different litigations going on at the time as well. We were steadily working through the process, but there was cleanup that needed to be done. And the ultimate goal of a Chapter 11 process is to emerge with a viable business plan going forward in a serviceable debt load. There was definitely, I would say, questions about, what does that sustainable debt load look like? What are the necessary needs for a company in a volatile industry to be able to, have a go forward plan? And so working through all of those things was definitely a challenge, right? We took 13 months to go through the Chapter 11 process, which is not really a short or a long Chapter 11 process. But obviously, when we went in, it was a thought that it would be a lot shorter of a process. So when I joined in April, it was about getting down to, what are the things that we need as part of the emergence? Those 2 things were really time and optionality, which our creditors agreed with. Our creditors were like, yeah, absolutely. You guys need to both experience the bull markets but need to be able to survive bear markets. And so that's really what we were able to do. We had a successful emergence from our Chapter 11 process. We were able to eliminate $400 million in debt. We had to protect the downside for our debt holders via some new debt instruments, but we also provided upside to existing equity holders. They had the recovery of the common equity, but also 2 tranches of warrants as well. So for us, going through 2023, essentially having both hands tied behind our back, trying to figure out what are the things that we can tackle throughout the course of this process. One of them was, what are our processes internally, and how can we speed up decision making? How can we speed up, how we're thinking about the business? All of those things we were able to tackle through 2023. I mean, you take the company that grew the fastest, built the best infrastructure in the industry, the first to 100, 250, 500, 700 megawatts. And we had built so much infrastructure, not only hard infrastructure assets, but we had built the only software stack that incorporates all 3 levels of the Bitcoin mining software stack, which is fleet management, energy management, and firmware. And thinking about how do we utilize all the capabilities that we have to improve the efficiency of our machines with our existing machine fleet. And so we've actually been able to, and you can actually see it in our numbers of Bitcoins produced per exahash. Over the course of 2023, we steadily increased that number. And when you compare it to our scaled peers, we far outstrip them in terms of Bitcoins mined per exahash. That's very difficult to do. Achieving efficiency at scale is something that's actually very difficult to do. So it's easy to have very strong efficiency if you're running 25 megawatts in a single facility. It's much harder to do when you have 7 facilities across 5 states running over 200,000 machines. But we're able to take all of our experiences that we've had throughout the course of the company's history. We've been operating for 7 years. We've operated over 700,000 machines in our facilities in the past. So a lot of learnings, a lot of variable collection. We've collected a lot of data, and we're actually able to include additional hardware components such as pressure sensor data. When we're capturing wind, temperature, all of these things, because the wind on one side of the building actually might affect the cold aisle by, let's call it 10 degrees versus the other side that has the sun focused on it, which might increase it by 10 degrees from its normal ambient temperature. And so taking into account all these factors so that we can optimize the firmware to run our machines more efficiently. And you actually see that play through in our numbers over the course of time.
Yeah, we had a podcast yesterday, and we were going over the February numbers, Adam. And one thing we mentioned on the podcast was actually the consistency that you show in your mining updates month by month. And you only actually put in your total hash rate. You don't normally tend to go down the route of also including an operational hash rate, whereas most of the miners now are starting to include that. So it allows them to highlight that they've had some maybe curtailment, maybe some software updates, maybe some miners that are offline. And so, when I've produced tables before of performance, you've never finished really in the sort of like the bottom third or maybe the top third. You've always been consistent in that sort of like middle ground, but you only give, Riot Platforms, you give your full hash rate. And I suppose like Jason articulated for his company, you want to be judged on your total hash rate and not coming with a sort of like an operational hash rate, which, in theory you could provide because you've got all the data at your hands there to know what the downtime was during that month. And so, I give you credit for that. It's some good points you've raised there. Thank you, Adam.
Yeah, I mean, just to go back to those, the efficiency metrics, we don't want to game our metrics. We want to give the people all of the available data points, right? And so for some companies, they're giving slot utilization rates, and they're not talking about the fact that they have exahash sitting in boxes on the ground. And there are other companies who are, very confidential about how many machines they actually own, how many machines are actually running, and they essentially kind of give you the number that gets you to a very high operational uptime. And when you start to actually understand how all of these companies are actually reporting, you start to get a much deeper look into, it's like, well, what are they trying to hide in these metrics? What are they trying to hide in the numbers that they are providing this month, but didn't provide last month, but provided 2 months before that? And you start to follow the trends and you start to go, oh, well, they didn't report it that month. Let me actually try to solve for that number. And you go, oh, it's because the number is bad. We're giving you consistent numbers every single month, judge our performance on everything that we have, right? And we think that's a much cleaner story to investors because there's never a moment in time where we have to say, well, we didn't provide it that month because it wasn't that good.
Yeah, I mean, from my perspective, the ultimate metric is going to be around profit. So we can put as many utilization, Bitcoin mined per exahash. They're all nice metrics in terms of graphs, and they look good. And for some companies, they look great because they if they're doing well in those tables, it stands out. But at the end of the day, when it comes down to quarterly and full year accounts, that's where it matters, really, that metric there about profit. So obviously, we'll be hoping that 2024 for you guys, we've seen what happened in 2023. There was nobody surprised when the results came out, where they were. But 2024 now, and we'll go on to some of those issues, around the warrants in a while. But over to you, Bryce. Yeah.
Yeah, no handicap in your golf game, Adam. I like it. You're holding yourself to the highest standard, just like Jason over there at Riot. Now, next question. This is super timely, and I'm curious to get your thoughts as the head of one of the largest Bitcoin mining companies in the world, specifically based in the United States. I think you said 5 states, 7 facilities. We got to ask about this proposed tax from the Biden administration. It's a 30% total tax on Bitcoin mining companies. It's staged over 3 years, so a 10% per year tiered approach. Adam, what are your thoughts on this? Is this a concern for your company? How do you feel you're going to navigate this? Do you think it'll go through? And is there any benefit to the industry by having this type of a tax?
I would say there's probably not a benefit to having the tax on our industry. But we're lucky right now. House is majority controlled by the Republican Party. I think our biggest risk I would say it's not just the tax, but all of these other things like the EIA survey, all of the attacks on Bitcoin mining that are consistently coming through the Democratic Party is if we kind of know where they're going, right? So if we move into a place where the Biden administration is reelected, then we know where they're headed. And so if we lose control of the House, these are all things that could potentially be issues in the future. I think where we stand right now, it's not necessarily an issue, but there's definitely possibilities if in 2025, we're sitting with Joe Biden as president again, where they're going to take a much closer aim at Bitcoin mining. And so that's obviously a great concern for us. We've spent a lot of time speaking with not only our state level folks, our state level representatives, but also federal representatives as well, to try to get a better handle on how do we protect our business, right? We provide hundreds of jobs across multiple rural areas in the United States in places where they were decimated from a manufacturing perspective, right? 3 of our facilities are brownfield conversions to Bitcoin mining facilities. Those exist because something drove those companies out of that state or out of our country. And so if we want to continue to drive job growth in rural areas, you need to provide an attractive environment for those companies to stay. The consistent attacks on our industry, we understand why they're doing it. It's clearly because, whether it be large banks or Berkshire Hathaway wanting to put up more peaker plants, whatever it might be, they're getting heavy lobbying dollars paid into them. And so for us, it's really just a protectionist game at the moment where we're trying to protect our industry from heavy lobbying dollars from larger corporations who don't necessarily want to have Bitcoin miners involved because they want to take the profits for themselves.
Two points to add to that. One is, say, for instance, the tax came in. I mean, you've already articulated, you're probably, certainly one of the biggest miners in terms of, assets under management, megawatts and all that. It's not going to be easy to sort of like relocate to another country for you guys, is it? Or is it, would that be sort of like considered an option to even think about? And secondly, this is more about why they, is there any sort of legitimacy bringing a tax in because the actual infrastructure for energy in the US isn't as great as it could be, and therefore it needs investment in that infrastructure? And are they picking on the likes of a big energy user industry to sort of like help fund that? I don't, that's where we're saying, like, are you feeling happy with the level of energy that you get at all your sites, or do you feel sometimes it's a challenge because the infrastructure isn't as good as it could be elsewhere, maybe?
Yeah, some of the areas that we've moved into have had dormant electrical infrastructure for years, and in some cases decades, because once manufacturing moved out, it was really challenging for them to get the funds. They didn't have the tax dollars to upgrade those electrical lines. In some of our places, or in some of our locations, we've actually had to pay for the upgrading of transmission lines to our facility. And in one case in particular, it actually ended up lowering the power cost for the local community because they were losing so much on these essentially, ancient transmission lines that they were losing a lot of power across the transmission lines. And by us paying for those upgrades, it actually provided an uplift to the local community. And so from our perspective, yeah, absolutely. I mean, it goes across the United States, though. You look at where manufacturing was located in the 50s, 60s, 70s, 80s, all of those places have had a lack of investment over the course of the past 30 years, mainly driven by the fact there's almost no tax dollars in those jurisdictions anymore to be able to afford to pay for upgrades to transmission lines. And if they upgraded them, sometimes it's a bridge to nowhere, right? They upgrade these lines. Where is the power going to go? The local community is slowly losing population because there's not enough jobs. And so from the moment we enter into a location, it's really important that we understand the local community. We're very active in the local community, and we're very active with our local utility provider. Operating in 5 states, we have to operate across a large band of different types of utility providers, from small regulated utilities, obviously all the way up to ERCOT, and being able to provide guidance in terms of what our needs are, what our expectations are. And in many cases, when we have an expectation of uptime that's different from what they're able to provide, that often results in upgrades to infrastructure that we've paid for in the past. And so I completely agree. It's a place where I think there's a lot of education that needs to be done around all of the work that Bitcoin miners have done to help upgrade electrical infrastructure across the United States. I saw a document, I believe it was put out by Bain. It was talking about, right now to put up new transmission lines in the United States, it's between 15 to 20 years, and it can require up to 13,000 permits. Those are things that are preventing power from getting to locations that desperately need power, right? And so our ability is to actually move to those locations where there's power, but there's no transmission lines. It's often stranded in locations, and actually provide jobs to that local community to take advantage of the fact that, the permitting process across their state is terrible, and it's going to take another 20 years before they're actually going to be able to sell that power profitably to another major metropolitan area. So absolutely, the United States has a lot more to do on the electrical side.
Yeah. No, that's a similar sort of like as to what, and actually you operate in similar areas to CleanSpark as well. You operate in, is it Dalton? I believe you operate in Dalton.
Yeah, we've been in Dalton for a while. It's one of our first locations, actually.
Yeah, and Matthew came on the show a few weeks ago, and he articulated about how the community benefits and how the local jurisdictions there benefit from the tax dollars that come through from the services, and that certainly needs educating and putting out there, because people aren't aware of this. They see Bitcoin, they see energy, and they think it's just like it's just taking over. The next question we've got was probably the most asked question of all the questions, and it's around about the shares and the warrants that were issued post emergence from Chapter 11. And I'm an accountant, and I sort of like struggle on my first read of it through. I get it, but if you can articulate it as if you're talking to an audience of 12-year-olds, that would be sort of like really helpful, because they all don't get it at the moment. And I've even spoken to some people who I'd expect to know, and they don't sort of like fully get it. So talk about what the warrants and the shares that came out. And then there'll be a couple of follow-on questions as to what happens at the point of the first warrant reaches its limit level, and people would expect it to obviously buy that warrant. And I'll come on to those questions, but if you can just sort of explain about what was issued first, then we'll go on to some more questions.
Yeah, of course. So let's start with why the warrants were issued. We'll talk about what warrants are. So why the warrants were issued were because we had to set the valuation for the emergence, which is highly negotiated between all the parties, about 4 months in advance. Very difficult to set valuations 4 months in advance in an industry that our stocks trade on, pretty high volatility metric. So setting up 4 months in advance, we wanted to protect the upside to equity investors. So protecting the upside for equity investors meant that they received a certain portion of the company at emergence, about 21%, and then protecting the upside meant giving warrants that kicked in at certain levels or gave existing equity holders the right to purchase a share once you cross certain thresholds, right? So the first tranche of warrants, and it's almost best to think about them as kind of two separate instruments completely. The tranche one warrants have an exercise price of $6.81. And so what does that mean? It means you have the right to purchase a share for $6.81. So if it trades to $7, you paid $6.81 for that share. So it's essentially a call option on a share to purchase in the future. And you have 3 years to exercise that warrant. Now, that's a cash exercise warrant, meaning you're paying that $6.81 per share to purchase a share. But in total, that brings in $670 million into CORZ Scientific upon full exercise. The point of that warrant was to say, all right, when we cross that threshold, put us in a positive net cash position, essentially pay off the $348 million of non-convertible debt, and then put it another $322 million in the balance sheet. That's the ultimate goal of that warrant, is actually improve the financial position of the company. Our view is that once we kind of cross through that metric of 681, it puts us on a much different playing field in terms of our ability to go out, continue to refresh miners, potentially accelerate some infrastructure development. It puts the company on a much different trajectory once we're actually able to cross that threshold. Now, the tranche two warrants have a strike price of $8.72. Now, that is a different instrument. It's called a penny warrant. And so that means when the stock price crosses $8.72, you're paying a penny to purchase that share. You're not paying $8.72 like you are for the tranche one warrant where you're paying $6.81. The cost of a share is only a penny. And so in total, between those two tranches of warrants, the existing equity holders are essentially given back 44% of the company. And so it was an extremely valuable, those two instruments have had an extraordinarily high value to the existing equity holders because it represented the ability to essentially take back a majority of the company for the existing equity holders.
Yeah. So looking at the tranche one, which is at the 681 threshold, which you articulated, the expectation is obviously to try and for as many shareholders to buy that warrant, because obviously the 670 million. Do you sort of do any modeling to say, the what if scenarios? If say for instance, I've got some shares in CORZ Scientific, and say for instance, I couldn't afford to pay all the warrants, and I run out the date there. I lose my warrant, but you lose the relevant income associated with that warrant forward it. So 670 million is the maximum. Is there a sort of is there a play on what that looks like?
So if we get up to 3 years when we're trading above 681, depending on how high we are above 681, most people will have exercised, because once you go above a certain level of 681, there's more downside to not exercising, because you'll start to lose option value as it breaks through that 681 price. Whereas once you're above 681, it's essentially going to trade in line with whatever price it is above 681. And so you have more value in exercising that warrant than you do trying to hold it to maturity. Now, the part of it, which is interesting, is there are actually a number of funds that part of their strategy, they're essentially warrant funds. They go out, they're not only buying very cheap volatility warrants, which are kind of how warrants are priced based on the volatility of the underlying, but also they're going out into the market as cash exercise warrants near maturity. And so let's say you have 10 warrants, you might say, all right, well, I don't want to put out cash to purchase these underlying shares. Well, I haven't done the math, but let's say you might be selling 4 of those warrants to get essentially an equivalent net settlement of 6 shares. And so the people who are often buying those warrants are often warrant funds who are taking those shares, exercising because they bought it at a discount, and then that's the arbitrage that they're playing. So the chances of not getting 680 or 670 if we're above that strike price is very low, because there are people in the market that are actually making that market more efficient.
Yeah, and obviously, we've seen the influx of the investment into the ETF funds since January, and that doesn't seem to be slowing down at all. I think it was only a couple of days ago we had a $1 billion inflows into those companies when you guys mining Bitcoin could only produce as a total $65 million of Bitcoin in a day at 900 coins. So, we how long before that market sort of like, they're starting to look at, well, where do we get the next Bitcoin? Because Michael Saylor's not selling any of his, and I'm not selling any of mine. And there's a few other people out there said they're not selling theirs. So, the demand will far exceed the supply. So maybe that 3-year period now, gives some optimism for shareholders. But yeah, that was probably, I think, the most asked question, and I'm glad you've articulated that way, because it reaffirms what I believe, but actually, I think it will help a lot of shareholders out there understand what they've actually got now, because there was a lot of questions coming through from the date that they were being issued, certainly to our channel, and we were saying, hopefully we'll get Adam on and he can explain it, and you have articulated it quite well. Thank you, Adam.
Yeah, I mean, from our perspective, where we're trading right now, on consensus estimates, we're trading at essentially 6 times EBITDA. Our peers are trading 15 to 23 times EBITDA. We're not even expecting to trade in line with the peers, right? Even if we trade towards the peers, we would be above the cash exercise price for the tranche 1 warrants. We'd be above the mandatory conversion price for the convertible notes. And it's cheaper right now to buy CORZ Scientific and buy Bitcoin than it is to go out and buy a company that is literally 3 times more expensive. Not 3 turns on a EBITDA turn, but literally 3 times more expensive.
Yeah. Understand that, yeah.
No, I appreciate the clarity, and I think what you said, Adam, to think about them as 2 separate vehicles, the penny warrants versus the cash warrants, makes a lot more sense. So appreciate the context there. The next one here, shifting gears a little bit, CORZ Scientific's actually the first company, and Anthony and I did not expect this, of your size to enter the HPC AI vertical. We've seen a lot of the big players kind of focus on the pure play Bitcoin mining going into this bull run. We've seen a lot of the mid tiers kind of venture into that HPC space. Obviously, there's great benefits of stabilizing revenue and a non-having correlated revenue stream. What's the thinking from CORZ Scientific, and what opportunities do you see there, Adam?
Yeah, I think it's best to look back at the history of CORZ Scientific. One of our first CEOs was the former chief operating officer of Microsoft. He was the chief operating officer for 15 years. And so he was there during the identification of a number of our original sites. The criteria used for identifying sites for Bitcoin mining was very similar to the strategy that Microsoft had used to identify sites for data center opportunities. So it was low cost power, essentially firm generation power, meaning the ability to have at least 99% uptime, low latency to major metropolitan markets. Those are all factors that came into play as we were identifying some of our initial sites. As we look forward, the way we think about the business is, are all the assets that we own going to be competitive in 2028, right? And that's a big deal, right? Because 2028, without making a large assumption around the price of Bitcoin, is going to be potentially a reckoning year for Bitcoin mining. You need to have very advanced power strategies. You need to have locations where you can be very selective about the efficiency of machines that you're choosing, and not just having to constantly jump to the highest and most efficient machine to have a profitable site. So as we were evaluating our infrastructure stack, our infrastructure team, our operations team, is led by a person who was formerly head of HP data center design, went on to run a lot of data centers for HP, went on to run 50 data centers and over 1 gigawatt of power for Equinix after. And when he joined CORZ Scientific, he brought with him a large group of his former HP employees, actually, because they were located in Austin, Texas, where CORZ Scientific is headquartered. And so, the CoreWeave deal was a very interesting opportunity for us to help solve a very near-term issue for CoreWeave, which was getting infrastructure online very quickly. It's actually a facility that was designed by Matt Brown, our head of data center operations, and operated by a majority of our team in-house. So they know that facility extraordinarily well. But looking forward, we talked a little bit on our earnings call, but we believe 300 megawatts of our existing infrastructure fit the needs of HPC clients. And we've been in negotiations and discussions with about 5 clients who have the ability to pay for majority, if not all of that CapEx for the conversion. And if you look at the way we designed our facilities, because we were the first company to build at scale outside of China, really, we took a traditional data center design. So if you look at our facilities and you compare them to the data centers that were built in the 2000s and 2010s, it actually is almost identical to those data center designs. Just we stripped them back, for the requirements and the needs of Bitcoin mining. Brownfield construction is not a new thing in the data center industry. So we've been working with, one of the largest GPU manufacturers in the world, as well as a few design firms on what that conversion looks like. This is mainly around driving a lot of our existing capacity that we believe might not be competitive in 2028 to other use cases and being nimble enough to have that ability to convert. As part of this, we still have 372 megawatts of Bitcoin mining, and so we can continue to increase our Bitcoin mining infrastructure while also converting some of our existing space. And then it's also led to a question that actually Anthony asked earlier that I'm realizing we didn't touch on, which was international expansion and other opportunities, which is, we're still going out RFPing on new sites, trying to find interesting sites that have, I would call it, a bespoke competitive advantage, whether that be power, whether that be jurisdiction, and whether that be, cheapness of build outs in that location, whether that be environmentals. These are all different variables that come into play as we're evaluating new sites. So it's not a pullback from Bitcoin mining. It's saying, if we want to be and continue to be one of the largest digital infrastructure developers in the United States and continue to be one of the largest Bitcoin mining companies, well, we need to have a much more active strategy on our infrastructure. And we just can't sit around and say, yeah, no, that's going to be fine 4 years from now at the next halving, because the truth of the matter is we don't know without making significant assumptions around the price of Bitcoin.
Great. That's very similar to what we heard from Sam from Bit Digital as well, and not basing your business model around the hope or expectation that Bitcoin price is going to be at a certain level, right, Adam? So very, I think, well-managed, responsible outlook here. And it's interesting, Anthony, this is, I think, the first time we're starting to hear people talking about not only this halving, but now the next halving, Adam, in 2028, which you just mentioned there as well.
You got to be focused. In this business, you have to take a 5-year view on it. Too often, we've seen companies take a 1-year view, or sometimes it feels like a 6-month view. And to build a long-term sustainable business that produces very consistent free cash flow, which is what our investors want in the long term, is the ability to forecast the business, understand what the cash flows look like, understand what the risks are. We've been very open about all of those things, where we stand on free cash flow, where we stand on our infrastructure assets, what are the pros and cons of all the infrastructure assets that we own. And so from our perspective, being the largest Bitcoin mining company in terms of Bitcoins mined, it's like, okay, well, we have to provide thought leadership in this space as well, because everyone else right now is like, bull market infrastructure is okay. Bull market infrastructure isn't okay. Bull market infrastructure is a term I use for infrastructure that's only viable during bull markets. That's not okay to be overpaying for assets for bull market infrastructure just because, today it looks attractive. Well, will that look attractive in 2028?
Yeah, no, it's a good point. Just talking about production, and from your perspective, obviously you've got a hosting business as well as a self-mining business. When I look at your updates, you'll articulate both the Bitcoin mined, and then you'll articulate the Bitcoin sold. So my assumption is, are you receiving some hosting rewards in Bitcoin because you're selling more Bitcoin than you're self-mining? And so, because you don't put a HODL, I've always assumed that you didn't have a HODL. You were selling Bitcoin regularly. And what we've seen some of the miners doing this last sort of 3, 4, 5 months is they're starting to really focus on building a HODL. Mm-hmm. And obviously, their mindset was on the Bitcoin price rising, and we have seen it rise. It might have dropped in the last 3 or 4 days, but up until a week ago, it was a 70% high year to date. 155% up in 2023, so significant rise in Bitcoin, and we've seen 4 or 5 of the miners really now hardly spending their Bitcoin. What's your stance on hodling? Is it because obviously you have significant amounts to pay out from a monthly basis? Is it a case of we've got operational expenditure to cover, and therefore we're not focused on that? Or what's your view on the whole situation at the moment?
Yeah. All right. So there are a number of questions there, Anthony. So I'm gonna choose one, and we can come back to the rest of them. Yeah. I don't know if I can remember all of the questions. So yeah, absolutely. In 2023, we sold all of our Bitcoin. It was mandatory part of the bankruptcy process. So we had to be consistently selling our Bitcoin. We went back to 2022. We were one of the largest holders of Bitcoin of any companies. I believe it was only probably second to MicroStrategy at the time in 2022, over 600 million in Bitcoin at a time when almost no one else really had a large amount of Bitcoin in treasury. Fast forward to today, we have leverage on the company, and some of that leverage dictates that we have to be selling our Bitcoin not on a daily basis, but within a certain time period. And so for us, what we're really focused on right now is continuing to grow our infrastructure base, continuing to refresh our machines, because we believe it's the right thing to do from a long-term perspective as we just emerged from, our Chapter 11 process, and we have some catch-up to do, essentially, right? We have 372 megawatts of infrastructure assets that if we had all $77 million to finish those infrastructure assets, they would be completed within 12 months because we've already put the long lead items in and everything. There's pads laid. In some cases, there's buildings. In some cases, there's buildings with shelvings, and you would ask yourself, why aren't machines running? And so it's about bringing that infrastructure online, refreshing parts of our machine fleet. All of those things are important to ensure that we put the company in the best position going into the halving so that we can put cash on balance sheet and be much more aggressive in terms of machine purchases if in a post-halving environment, machine prices get more volatile, to essentially protect the long-term growth trajectory of our company, right? So we have a use of capital that is a high return. And so from our perspective, outside of the covenants right now around selling Bitcoin until certain debt instruments are cleared, our focus is on growing the company and building a much more long-term sustainable company from the perspective of having the largest infrastructure fleet, always being one of the most efficient mining companies. All of those things are extraordinarily important to us right now, and we do have to play a little bit of catch up.
Has that benefit in Bitcoin price in the last few months enabled you to do more then, obviously, because there's obviously you're still mining significant amounts of Bitcoin, and with the price increasing by 6-7%, when you're planning at the end of 2023 for 2024, what's that sort of like early period enabled you to do that you weren't anticipating?
Yeah, so look back at 2023, we paid well over 100 million in cash restructuring expenses alongside of paying off a $42.5 million dip, obviously producing a significant amount of free cash flow, which should free up our ability. We had signed the XP deal with Bitmain as part of our emergence plan for just over 28,000 machines, XPs. We were also able to then sign an S21 deal. And we actually noted this in our most recent operational update, that we actually accelerated all of the payments on that to actually speed up and bring forward the delivery of all of those units. So it's provided us some additional flexibility on that side. But right now, in terms of new machine purchases, I think we're in a little bit of a mispricing of existing machines and new machines. The fact that new S21s have moved into the mid $20 dollars per terahash last week, from our perspective, that means that we need probably have an 8 to 9 cent hash price post halving. I don't think we're going there right away. And so I think, there's going to be a little bit of a mispricing. I think some people have overcommitted on S21s. It's a similar situation to what we saw in 2021, right? People putting massive purchase orders in and then having to part out those in 2022. And then at the same side of that is the XPs. There's going to be no room for XPs. Essentially, there's a lot of XPs floating around the secondary market right now. And the ability to buy XPs, which we know we can operate more efficiently than spec, those are really attractive investments for us because, right now in the secondary market, they're trading, let's call it $17 a terahash for, relatively immediate delivery. But post-halving, is that the right price? Probably not, right? So it's like put cash on balance sheet so that we can execute them after the halving when we know market pricing will prevail and we'll have an opportunity to actually execute a much more pointed strategy on the refresh program.
Just as you mentioned machines, and that's a good point. We know there's got the three big manufacturers at the moment. We've got the Bitmain, MicroBT, Canaan. But there's also other players coming into the market this year. You've got Epic, you've got Auradine, and you've also got the latest update from BitDeer Technology, where they've just tested their machine with an 18.1 joules per terahash efficiency rate, which isn't that far away from the S21. Is having these, and you talked about the price there increasing. We saw this price increasing with the Bitcoin price in 2021, and miners were chasing machines all through that year. I remember two, and I won't name them, but two miners were paying $80 to $90 a terahash at the end of 2021 chasing machines, and those two miners you don't hear that much of nowadays, because that's paying that amount. You're getting debt as well to pay for those miners. The value of those miners came down. But are you sort of like with new entrants to the market? Does that give you some optimism that there'll be more competitiveness, or do you think actually the three big ones are too big, and all these new entrants are going to really struggle to get their own space in the market? How do you see it?
So there's a few different strategies that new manufacturers are coming to market with. I think new manufacturers are coming to market right now. Some of them are pricing on an ROI basis, similar to how Bitmain and MicroBT price their machines. I think those will struggle to find a footing. I think people that are focused on a cost plus model will actually find a footing when Bitcoin price is outpacing hash rate growth. They will, because they're always going to be priced more cheaply than a Bitmain or MicroBT. Now, my excitement around this is I believe in Q4 of this year, we'll finally start to see the beginnings of the democratization of hash rate, meaning the ability to buy hash rate from a number of different parties is finally going to be something that exists in the market. We've been promised this for, many, many years. And it hasn't come to fruition, but it feels like, given the number of participants, given the backgrounds of the people that are coming to market now, very, very interesting setup for the end of this year as these companies start to move to higher production numbers. Now, the other side of that is potentially bringing on a significant amount of hash rate onto the network, and it's going to create a much more challenging environment. I think there's going to be cycles, but they're not going to be the same that they are for Bitcoin mining companies, for manufacturers, where during periods of time where the market is in doldrums in terms of mining economics, the cost plus model isn't going to work well, because they're always going to feel very expensive compared to secondary market or potentially to Bitmain. I think the other side of that is, similar to what we saw in 2023, where XPs weren't essentially being sold into the market, Bitmain was maintaining ownership and hashing with them. Could we potentially see that out of some of these new manufacturers during those periods of time? And potentially, I'm actually surprised we haven't seen more Bitdeer-like companies. Like, think back to the number of manufacturers that existed in 2015 and 2016. There were a number of different manufacturers. They all kind of disappeared, right? Bitmain essentially, triumphed over all of them. But could they have stayed in existence if they just chose to self-mine? Could Canaan completely pivot and just only be a self-mining company? Yeah, that might be like the only way for some of these companies to survive, right? So I think it's an interesting setup. I think 2025 is going to be really interesting when we actually have the ability to buy machines from a number of different parties. I think the big question mark is, what's the staying power? What's the balance sheet look like for all of these manufacturers? And how much confidence do large miners who, for a company like us, a small purchase is like 25,000 machines, right? That's a small purchase. That's like a test batch. And so will other large mining companies work closely enough with these manufacturers to actually want to make large purchase orders? From our perspective, we've been working very closely with a number of them because we believe that there's a really interesting opportunity. Now, have they been able to produce at scale with high production numbers? No, not yet, but maybe in the future they could. From our perspective, it's a really interesting setup.
Just having Bitmain have sort of like part of the company, does that help the relationship with them, or is it from purchasing miners? It's a commercial transaction. You're fighting as well as the next miner for machines. But they're sort of like a part owner of Core Scientific, obviously with the restructuring.
Mm-hmm. Yeah, they own about 6% of the company. And so we've been very open with Bitmain about this. From their perspective, even as these new competitors come to market, they're not going to be producing anywhere close to the amount of machines that Bitmain is, and Bitmain is and has been the most efficient machine on market and first to market, right?
Yeah. So context about them, but Bitmain is bigger than the miners added together in terms of market capitalization. They're a private company, but if they went public, they'd be bigger than all the North American mining companies added together. So just to give you an indication, I think it's like 4 years ago there was a talk about 50 billion then. What that figure looks like now, I don't know, but potentially, they're not a small piece in this. And I know some of the miners I've talked about. I think I didn't include Block in that list as well. Block are also doing some development. And actually, you as a miner, you'll get to know all these machines anyway, because generally when new entrants come to the market, and with Bitmain's, the T21S1s, you'd have got access to those machines, at the start as test machines to see how they would perform in your sort of like facilities. And we had Ben on last week, and he articulated that Bitfarms had tested the T21, and the results were absolutely amazing compared to the standards. He was exceeding, 20-30% higher than what the standards were that came on the box. So they were very impressed, and we've seen a lot of companies going by the T21 now. Not as powerful as the S21, but it does have that ability to increase the power, and also that's within the warranty as well. So I think it's one of the first miners who've been allowed to change the ability to do that without falling foul of warranty.
Yeah, I will say, Ben is an incredibly talented individual. He's been in the space for a long time, and when people ask who do I respect in this industry, Ben is always at the top of the list.
He's on everyone's list, I think, at the moment.
Yeah.
We have the same
He's a wealth of knowledge.
Every miner wants Ben in their team, so he must be doing something right. But thanks for your candid remarks on that. That's helpful for investors.
Yeah, and I would add one point. We have a very large, we call it the sandbox. We have a very large R&D facility where we're testing all of these machines, testing our firmware, testing how they're performing in different environments. We literally hit them with a rubber sledgehammer to essentially the Christmas box test. Does it make a sound? And then we also operate the machines. We send test units out to North Dakota and to Texas, because those are two of the more extreme environments, and they're the most extreme because North Dakota is less than 0 degrees for 100 days a year, and Texas, it's greater than 100 degrees for 100 days a year. So we get both sides of the temperature swings, and then it also tells us and informs us, because we participate in power programs, how do these machines start up when they're hot? How do they start up when they're cold? How do we have to volt them when they're very cold? All of these things are question marks when you first receive a new machine, because you could damage a bunch of machines if you don't accurately calculate how you need to start these machines up in, let's call it, negative 30-degree temperatures. Those are all question marks when you first receive a machine. And so knowing how they operate at those different temperatures, it also informs, before we put 10,000 machines on the rack, how the machine's going to perform if it's at 110 degrees out in one of our forced air facilities in Texas. How does it perform? What's the degradation of terahash and wattage? What are all of those variables so that we can tune the firmware to optimize the performance? Because if you don't do that, and you're deploying as many machines as we're deploying, you can really put yourself at risk. If you buy 20,000 machines of one machine type that ends up being a dud for one reason or another, that's a big issue, right? And so we like to avoid those issues. And so we test all our machines extensively before we place purchase orders.
Good, excellent.
Yeah, it makes sense, and it reminds me of the point you brought up at the start of the hour there, Adam, about doing things well is one thing. Doing things well at efficiency and scale is a whole nother thing. So whether you're building machines or operating data centers or whatever the case, but it's been a great discussion. We've covered a lot of points here. Adam, I'll kick it back to yourself and Anthony for any closing thoughts here, but really eye-opening and great conversation.
I've just got one final point, and I'm not sure you articulated in your open statement, but a lot of the miners now have provided growth strategies through to the end of 2025. What's the strategy for Core Scientific over the next 18 months, if you can give us a sense of what direction we're going in?
Yeah, so the interesting part is they might have provided through 2025. We actually had to provide a 4-year growth plan as part of our emergence from Chapter 11. So our plan right now is to execute on the 72 megawatts that we have at Denton. Those are very near-term megawatts that we can bring online. And then the focus is the next 100 megawatts in 2025. I would say at the highest level right now, we're focused on putting cash on balance sheet to be able to execute on machine purchases and refreshes throughout the course of the rest of 2024. And then part 2 is trying to break through those levels in terms of share prices to actually exercise, the tranche 1 warrant to give us that pathway to delever the business. The moment that occurs, the business is on a completely different trajectory in terms of our ability to continue to expand. You're essentially unleashing the 800-pound gorilla from its cage. And so from our perspective, it's a really interesting setup right now because we're trading at such a significant discount to our peers that as people start to understand the business, understand what we've been doing, even in the course of 2023, when we had both hands tied behind our back, it's an interesting setup from our perspective because we have the ability to grow. We have the best team in the industry. We have the best software in the industry. Our ability just to refresh our machines can nearly double our exahash exposure within a year. We can deploy 20,000 machines in a month easily. That means we're taking machines down, putting new machines up. And we can do that month after month after month. And it's not many other people can do that. And so we have a massive opportunity ahead of us that we're really excited to execute on. So I would say infrastructure development and then machine refreshes and also some machine expansion to fill out some of the new megawatts that we're bringing online.
Thanks, Adam.
Any closing thoughts, Adam? I know we went through a lot of topics today. I think you've been well spoken. You've definitely helped cleared up a lot of the question marks in my mind. But we'll flip it to you for any closing thoughts there.
Yeah, I would just reiterate some of the points. I mean, a lot of people know who CORZ is, but they forget about what we built. We were the first company to build at scale. We built it faster, built better infrastructure than our peers. We've mined more Bitcoin than anyone else over the past 4 years. We're continuing to do that today, even though we have a slight disadvantage to one competitor who has 8 more exahash than us. But we've still been able to mine more Bitcoin. Going forward, we have the best organic growth plan in the industry, 372 megawatts of partially developed infrastructure that can be brought online and accelerated as necessary. And we think, refreshing our machines post-halving presents a very good setup for us where we can actually be very accretive over the course of this year to our bottom line by waiting to buy, I would say a bulk of the new machines that we're looking at. So, overall, it's a great time to be at Core Scientific. We have a great runway ahead of us. We have a great growth plan. We're expanding to new verticals, and all of those items will be accretive to our Bitcoin mining business. And we're going to be able to continue to scale, continue to expand, and we think continue to outpace many of our peers just based on being one of the best operators in the space.
I think the bookies have got your favourites to achieve the most Bitcoin in March at the moment because social media seems to have a lot of posters analysing the 2 wallets belonging to CleanSpark and Marathon Digital, and you guys put your production out on a daily basis on X, so they can look at those numbers quite clearly. And I think you're sort of like at the moment I think you're probably ahead of the other two, but it's going to be a 3-horse race. But I think the bookies have probably got your slight favourite. And yeah, obviously February had a great performance in comparison to the miners. Came top of the production of Bitcoin. So long may it carry on this year. And really, thanks for the time today, spending that time to articulate. I know that warrant question, was asked by many people sent me DMs asking about that specifically. And I think you've covered that point there, and you've covered a lot of the other points that are going to be of interest to the retail shareholders out there and the followers from our channel. But thanks for your time today, Adam. That's really good.
Hey, we appreciate it. Appreciate the time.
There you have it, folks. For all the Core Scientific fans, you've got your interview. For anyone not currently holding Core, it may be worth a look. Adam, thanks so much. If you guys are still watching, feel free to subscribe, hit the like button. It's a huge help to the channel. It's free to do. And if we didn't get to any of your questions today, feel free to throw them in the comment section below, and we'll keep a tally for Adam next time you join us here. Thanks so much. We'll talk to you soon.